In 2008, millions of Americans watched their retirement dreams evaporate overnight. 401ks became 201ks, life savings disappeared, and people who thought they were financially secure found themselves starting over at 60, 65, even 70 years old. If you're watching this video, you're probably asking the same question that keeps so many of us up at night. Is my retirement really safe if the economy collapses again? Today, I'm going to give you the honest answer that Wall Street doesn't want you to hear. I'm going to be completely straight with you today. No sugarcoating, no false promises, just the truth about what happens to different types of retirement assets when the economy takes a nosedive. Over the next 20 minutes, we'll walk through exactly what happened in previous economic collapses, which assets got wiped out and which ones survived, and most importantly, what you can do right now to protect yourself. I've put together a comprehensive protection checklist in the description below that covers everything we'll discuss today, so make sure to grab that after the video. Let's start with the hard facts from 2008, because if we don't learn from history, we're doomed to repeat it. Between October 2007 and March 2009, the average 401k lost 25% of its value. But that's just the average. Many people lost 40, 50, even 60% of their retirement savings. I remember talking to a gentleman named Robert from Ohio who had $800,000 in his 401k in 2007. By March 2009, he was looking at $320,000, 15 years of careful saving and investing, gone in 18 months. But here's what most people don't realize. It wasn't just the stock market crash that hurt retirees. It was a cascade of failures that hit retirement accounts from multiple angles. First, stock-heavy portfolios got demolished. Then, corporate bonds started failing as companies went bankrupt. Real estate investment trusts, which many retirees thought were safe income investments, lost 60 to 70% of their value. Even some bond funds that were supposed to be conservative lost 20 to 30%. Now, let me explain the three types of economic collapse that can threaten your retirement, because understanding the enemy is the first step in defending against it. The first type is a deflationary collapse. This is what we saw in 2008. Asset prices fall, unemployment skyrockets, and cash becomes king. In this scenario, debt becomes more expensive in real terms, companies fail, and stock markets crash. Your 401k gets hit hard because it's mostly invested in stocks and corporate bonds. The second type is hyperinflation. Think Germany in the 1920s or Venezuela today. Your dollars lose purchasing power rapidly. A loaf of bread that costs $3 today might cost $30 next month. In this scenario, cash savings get wiped out, but certain assets like real estate and precious metals often maintain their value. The third type is a currency collapse, where the dollar loses its status as the world's reserve currency. This is the nightmare scenario that could make 2008 look like a minor correction. Now let's talk about which assets get hit first and hardest during an economic collapse. This is crucial information that could save your retirement. Stock-heavy 401ks and IRAs are typically the first casualties. Why? Because when panic sets in, institutional investors dump stocks first. They're the most liquid, easiest to sell. Your technology stocks, growth stocks, even dividend stocks. They all get sold indiscriminately. I've seen solid, profitable companies lose 50% of their stock value simply because they got caught in the selling tsunami. Corporate bonds are next. When companies start failing, their bonds become worthless. Even high-rated corporate bonds can lose significant value as investors flee to government securities. Many retirees think corporate bonds are safe because they pay regular interest, but in a real collapse, that interest stops coming and the principal value evaporates. Real estate investment trusts, or REITs, get hammered because they're tied to both the stock market and real estate values. In 2008, some REITs lost 70 to 80% of their value. Retirees who thought they were getting safe real estate exposure through REITs learned a painful lesson. Bank stocks and financial sector investments get absolutely destroyed. In 2008, major banks like Lehman Brothers went to zero. Even banks that survived, like Bank of America and Citigroup, lost 80 to 90% of their stock value. Now let's talk about what historically survives economic collapse. This is where you want to focus your protection strategy. U.S. Treasury bonds and bills have never defaulted in the history of our country. Even in 2008, when everything else was falling apart, people were actually paying the government to hold their money in short-term treasuries. Yes, the yield was negative, but the principal was safe. Long-term treasuries can fluctuate in value, but short-term treasury bills are about as safe as it gets in terms of preserving principal. FDIC-insured bank accounts up to $250,000 per account are protected by the full faith and credit of the U.S. government. Even when banks failed in 2008, depositors didn't lose a penny of FDIC-insured funds. The key is understanding the limits and structuring your accounts properly to maximize coverage. Physical precious metals, gold and silver, have been stores of value for thousands of years. They don't always go up during economic turmoil, but they rarely go to zero. In 2008, gold actually performed relatively well, rising from about $800 to over $1,000 an ounce, while stocks were crashing. Certain types of real estate can survive and even thrive during economic collapse. Not speculative properties or luxury real estate, but essential properties. Think farmland, rental properties in stable areas with strong employment, or your primary residence if it's reasonably priced and you have fixed-rate financing. I-bonds, or inflation-protected treasury securities, adjust their payments based on inflation. They're designed to maintain purchasing power even if prices rise dramatically. Now here's how you can protect your retirement starting today. This isn't about timing the market or making dramatic moves. It's about building a fortress around your financial future. First, diversify beyond traditional retirement accounts. If 100% of your retirement money is in 401ks and IRAs invested in stocks and corporate bonds, you're taking enormous risk. Consider moving some money to Roth IRAs, which offer more flexibility, or even taking some money out of retirement accounts entirely if you can do so without major tax penalties. Second, build a substantial emergency fund outside of retirement accounts. I'm talking about 2-3 years of living expenses in FDIC-insured accounts or short-term treasury bills. Yes, the returns are low, but this money isn't for growth, it's for survival. The specific banks and credit unions I personally recommend for high-yield emergency funds are listed in the description below. Third, consider allocating 5 to 10% of your total portfolio to physical precious metals. Not ETFs or mining stocks, but actual gold and silver coins or bars that you can hold in your hand. Store them safely, either in a home safe or a safety deposit box. Fourth, if you own real estate, make sure you have fixed-rate financing and avoid variable rate loans like the plague. In an inflationary collapse, fixed-rate debt becomes easier to pay off, but variable rates can skyrocket and destroy you. Fifth, reduce your dependence on any single income source. If you're still working, develop multiple income streams. If you're retired and living off Social Security and one pension, consider part-time work or other income sources. Let me share the biggest mistakes I see retirees making when it comes to economic protection, because avoiding these could be the difference between financial survival and disaster. Mistake number 1, putting all their retirement money in employer 401ks without considering the limited investment options. Most 401ks offer maybe 20, 30 investment choices, and they're almost all stocks, bonds, and mutual funds. You have no access to precious metals, real estate, or other alternative investments that might survive a collapse. Mistake number 2, assuming the government will bail them out. Yes, Social Security and Medicare exist, but they're facing their own financial challenges. Social Security is projected to be able to pay only 75 to 80% of promised benefits starting in 2034, unless changes are made. You cannot count on government programs to maintain their current level of benefits. Mistake number 3, keeping all their money in 1 or 2 banks. FDIC insurance is per account per bank, so if you have $500,000 in one bank, only $250,000 is protected. Spread your money across multiple institutions to maximize protection. Mistake number 4, ignoring inflation. Many retirees focus solely on preserving principal while ignoring purchasing power. If you have $100,000 in a savings account earning 1% while inflation runs at 4%, you're losing 3% of your purchasing power every year. Mistake number 5, panic selling during market downturns. This is how people turn paper losses into real losses. If you're going to hold stocks and bonds, you need the emotional fortitude to hold them through crashes, or you need to not own them at all. So here's your action plan moving forward. Don't try to do everything at once. That's overwhelming and leads to paralysis. Instead, tackle one item per month. Month 1, calculate your true emergency fund needs and start building it. Figure out your monthly expenses and multiply by 24, 36 months. Start moving money into high-yield savings accounts or short-term CDs at multiple banks. Month 2, review your 401k and IRA allocations. Are you too heavily weighted in stocks for someone your age? Consider shifting some money into more conservative investments, especially if you're within 10 years of retirement or already retired. Month 3, research precious metals dealers and consider making your first purchase. Start small, maybe $5,000, $10,000 in gold or silver coins. The exact dealers I've researched and trust are listed in the description below. Month 4. Review your real estate situation. If you have variable rate debt, explore refinancing to fixed rates. If you don't own real estate, consider whether it makes sense for your situation. Month 5. Diversify your bank relationships. Open accounts at 2, 3 different banks or credit unions to maximize FDIC protection. Month 6. Consider income diversification. This might mean part-time work, rental income, or other sources of cash flow that don't depend on the stock market. Remember, the goal isn't to get rich quick. It's to preserve what you've already built and ensure you can maintain your standard of living regardless of what happens to the broader economy. Let me be clear about something. I'm not saying the economy will definitely collapse tomorrow. Nobody can predict the future with certainty. But I am saying that economic disruptions are a normal part of history, and the people who survive them best are the ones who prepare in advance. Think about it this way. You probably have insurance on your house, your car, maybe even your life. You don't buy insurance because you know your house will burn down. You buy it because if it does burn down, you want to be protected. Diversifying your retirement assets is the same kind of insurance. The hard truth is that Wall Street makes money by keeping your money invested in their products. They're not incentivized to tell you about alternatives like precious metals, emergency funds, or strategies that involve taking money out of their management. That's why you need to educate yourself and take responsibility for your own financial security. I want to leave you with one final thought. It's better to be a year early than a day late when it comes to protecting your retirement. The people who suffered the most in 2008 were the ones who thought it could never happen to them. Don't be one of those people. If this video has been helpful, please give it a thumbs up and share it with other folks who might benefit from this information. The more people who understand these concepts, the better prepared our communities will be for whatever economic challenges lie ahead. Don't forget to check the description for that complete asset protection checklist I mentioned, along with my recommended banks and precious metals dealers. And make sure to subscribe for more retirement protection strategies. I post new videos every week covering topics that mainstream financial advisors won't discuss. Stay safe out there, and remember, hope for the best, but prepare for the worst. Your future self will thank you.